Welcome to your personalized deep dive. Today, we're going to take a deep dive into HDFC Bank's financials. You've given us a ton of reports, and we're here to kind of dig through them and see what we can find.
Yeah, exactly. We've got excerpts from their financial statements, profit and loss, balance sheet, cash flow. We've also got some of their communications to the Bombay Stock Exchange and the National Stock Exchange of India. And our mission is to equip you with a really clear understanding of HDFC Bank's financial health.
Okay, so let's get started. What's the first thing that kind of jumps out at you when you look at these reports?
Well, the thing that grabs my attention right away is the contrast between HDFC's sales figures and some of their other indicators. It's a bit like seeing a car with a powerful engine, but the brakes might be a little questionable.
Okay, that's an interesting analogy. So let's start with that engine, the sales. HDFC has seen some pretty impressive growth, especially recently. Can you give us some of the highlights?
Absolutely. If we look at just the last decade, we see consistent yearly growth exceeding 20%. But the really eye-catching number is the recent period ending September 2024, where they had a massive jump to 66%.
Wow, 66%. That's huge. Makes you wonder what's driving that kind of growth. Is it sustainable?
That's the million-dollar question. These reports tell us what's happening, but they don't always explain why. Are they expanding into new areas? Are they launching new products? Or are they just riding a wave of economic prosperity in India? These are the things that you'll want to explore further.
So while those sales numbers might look great, we need to be careful about getting too excited. You mentioned some other indicators that we should be cautious about. What should we be paying attention to there?
Yeah, so while sales are surging, their operating profit margin, or OPM, tells a different story.
Okay, I need a little help here. What is OPM and why should I care about it?
Well, think about OPM like your own personal profit margin. Let's say you earn €100, but you spend 90s to earn it. Your OPM would only be 10%. You need enough left over to cover all your expenses, save for the future, and, maybe have a little fun. And in the same way, HDFC needs a healthy OPM to reinvest in the business, grow, and keep their investors happy.
So a shrinking OPM means less financial breathing room for HDFC. What does their OPM look like?
For years, they enjoyed a really high OPM, consistently over 60%, which is amazing. But recently, things have taken a turn. By September 2024, their OPM had dipped to 37%.
It dropped from 60% to 37%. That's a pretty significant drop. What could be causing this? Is it a temporary thing or a sign of something more serious?
It's hard to say for sure without more context. Maybe they're facing more competition and having to lower prices, or their operating costs could be rising due to inflation, or, maybe investments in new technology. It's like solving a puzzle. We need more pieces to see the full picture.
So we've got this kind of strange situation with amazing sales growth, but a shrinking profit margin. It's like they're pushing the gas pedal down while the engine is sputtering. What about their cash flow? Isn't that the lifeblood of any business?
Absolutely. Cash flow is a critical indicator of financial health. It's like checking the pulse of the business. And looking at HDFC's history, their cash flow has been a little bit like a roller coaster.
Oh, a roller coaster. Uh-oh. Tell me more about these ups and downs.
Well, they've had times with really strong positive cash flow from their operations, which is what you want to see. But they've also had times where it dipped into the negative, as recently as 2019. By March 2024, they were back in the positive, but this volatility raises some questions.
Okay, so their cash flow situation seems a bit unpredictable. What's causing these changes? And should we be worried?
We really need to investigate further to figure out what's going on. Are these dips due to just the time of year, or are they one-time events, or is there maybe a deeper issue with how they're managing their cash? The recent positive numbers are encouraging, but they need that consistent, healthy cash flow for stability and growth.
It's like making sure you have enough gas in your car to get where you're going. So we've got these soaring sales, shrinking profit margin, and erratic cash flow. What other clues can we find in these reports?
Let's take a look at their balance sheet. This is the snapshot of their financial position at a certain point in time. And here, one thing that really pops out is how much their borrowing has increased over the past decade.
Hold on, don't companies borrow money all the time? What's so special about HDFC's borrowing?
It's the amount of the increase. Imagine you had a loan a few years back, and now it's 6 times larger. That would make you kind of nervous, right? Well, that's exactly what's happened with HDFC's borrowing between March 2015 and March 2024. It's gone up over 6 times.
Okay, that's a huge increase. Should we be worried? Especially with all these other things we've talked about.
It's definitely something to pay attention to. Borrowing can be a good tool for growing a business, but too much debt can make a company vulnerable. It's like building a house on a shaky foundation. We need to understand why they're borrowing so much and whether they can handle it. especially with their profit margin shrinking.
So it's like they're juggling a lot of balls in the air while standing on a wobbly platform? Not good. Anything else on their balance sheet we should be looking at?
There are a couple of other interesting things. First, their investments have also grown a lot, reaching a massive 1,005,681.63 by March 2024. Now, this could mean they're trying to diversify their portfolio and earn extra income.
That sounds good, right? Spreading the risk, boosting their earnings.
It could be, but it really depends on what kind of investments they're making. Are they putting their money in safe and stable places, or are they taking big risks trying to get higher returns? We need those details.
It's like choosing between putting your money in a savings account or betting it all on a risky stock. What's the other thing you noticed?
Well, it's more about what's missing. These reports don't have much information about their debtors or their inventory. Those details would give us a better idea of their working capital, how well they're managing their short-term money.
So it's like having a map, but some of the landmarks are missing. We need those details to really understand the situation. Okay, we've covered sales, profitability, cash flow, and the balance sheet. Anything else we should look at before we move on to a deeper analysis?
Oh, absolutely. We shouldn't forget their communications to the stock exchanges. These announcements, people often overlook them, but they give us valuable context about board meetings and when big financial decisions were made.
I'm listening. Why is that important?
Well, remember, these financial statements are just snapshots. Knowing when decisions were made helps us connect the dots and understand how those decisions impacted the numbers.
Okay, give me an example.
We'll take their communication from July 2024, for example. It informed the stock exchanges about their unaudited financial results for the quarter ending June 30th, 2024. This helps us track the order of events and understand how their finances have been evolving over time. It's like getting a peek behind the scenes.
That's a great point. Having that timeline can help us make sense of everything. All right, we've covered a lot of ground. We've seen impressive sales growth, but there are some potential issues with profitability, cash flow, and debt. Where do we go from here?
Now that we've identified these key areas, it's time to really dig in and dissect what's driving these trends. We need to assess what they might mean for HDFC Bank's future.
Let's do it. But first, let's give our listeners a chance to grab a drink and absorb all of this information. We'll be back in a moment to continue our deep dive into HDFC Bank.
All right, welcome back. So we've laid some groundwork. Let's see if we can solve this mystery of HDFC Bank's financial performance.
Yeah, I'm ready to put on my detective hat. Where do we start?
Well, let's go back to those impressive sales figures. 66% growth, that's incredible, but is it sustainable?
It's like a sprinter who sets a new world record. Amazing, but can they keep up that pace for a marathon?
Exactly. To figure that out, we need to look at their history and the industry as a whole. Is this growth normal for them? Is the economy in India strong enough to support it? And most importantly, what's causing it?
Yeah, we need to understand the why behind those numbers. New customers, new markets, new products, or are they just riding a wave that's about to crash?
Right. Figuring out what's driving their growth is key. Now let's move on to their OPM, which you compared to a sputtering engine earlier. How worried should we be?
Well, a drop from 60% to 37%, that's definitely a red flag. It's like watching your gas gauge go down when you're still miles from your destination.
A declining OPM means their expenses are growing faster than their sales. This could be for a few reasons. Competition, rising costs, maybe investments in new tech. It's like baking a cake. If your ingredients keep getting more expensive, but you can't raise the price of the cake, your profit disappears.
So it's not necessarily a bad thing if those expenses are strategic, like spending money on a new oven so you can bake more cakes. But how do we know if these expenses are good or bad?
That's the tricky part. We have to examine those expenses really closely. Are they investments that will pay off later? Or are they just costs that are eating away at their profits? We need to separate the good from the bad.
Okay, so we're starting to piece things together with sales and profitability. What about cash flow? You said it was a bit of a roller coaster.
And you don't want your business's cash flow to be like a roller coaster, right?
Yeah.
These fluctuations raise some concerns about HDFC's ability to, actually generate the cash they need to operate, invest, and meet their obligations.
It's like having enough money to pay your bills today, but you don't know if you'll have enough tomorrow. That's got to be unsettling for a big bank. So how do we figure out why their cash flow is so up and down?
Well, we can look at the different parts of their cash flow statement for clues. For example, changes in what customers owe them can impact their operating cash flow. Same with their inventory levels and when they pay their suppliers. It's like managing your personal budget, got to track your income, expenses, and when the money's coming in and going out.
So it's not just about the total cash flow, but understanding the details, right? Anything else we should be looking at?
Yeah, definitely. We need to check how well they're managing their working capital. That's the money they have to keep things running smoothly. Good working capital management means they have enough cash to cover their short-term debts while also making the most of their resources.
It's like making sure your car has enough gas to get you where you need to go.
Hmm.
Do these reports tell us anything about their working capital?
Unfortunately, there's not much information on their debtors and inventory in these reports. We'd need more detailed statements to get the full picture.
Okay, I'll add that to our list. Now let's talk about their borrowing. It increased a lot, and you said we should consider that along with their declining OPM. Why is that?
When a company's debt is growing quickly, you always have to look at it alongside its profitability. Can they make enough money to pay the interest on their debt and eventually pay it back? That's super important for long-term stability. When profits are going down and debt is going up, it's like running a marathon with a heavy backpack while you're getting tired.
That's a perfect analogy. It doesn't sound like a recipe for success. So how can we tell if HDFC can handle all this debt?
We can look at their debt-to-equity ratio. This compares their total debt to their shareholders' equity. A high ratio means they're using more borrowed money to finance their business. A little leverage can be good, but too much is risky, especially if the economy takes a downturn or interest rates go up.
So it's about finding the right balance. Any other red flags we should be on the lookout for?
We should also look at their return on equity and return on capital employed. These tell us how well they're using their investors' money and their own capital to make a profit. If those numbers are going down, it might mean they need to be more efficient or change their strategy.
It's like watching a sports team. You want them to use their talent and resources to score points and win games. Anything else we should explore?
Their investments are worth looking at closely, too. More investments can be a good sign, but we need to know what they're investing in and how risky it is. Are they putting money in areas with high growth potential, or are they taking unnecessary risks?
It's like being a detective and tracing a suspect's money. We need to know where it's going and if anything's fishy.
Exactly. By digging into these areas, we can really understand HDFC Bank's financial performance and get a good idea of their future prospects.
This is really interesting. We've covered a lot of ground, but I want to dive even deeper into their cash flow statement. There's still so much to learn there.
I agree. The cash flow statement is often overlooked, but it's full of insights. Let's take a closer look at its three main sections and see what we can find. But first, let's give our listeners a moment to catch their breath and process everything we've talked about so far. We'll be back in a minute to continue our exploration.
All right, we're back, ready to finish our deep dive into HDFC Bank. We've looked at their sales, their profitability, their debt. But there's one piece left, that cash flow statement.
Yeah, you're right. People often skip over the cash flow statement, but it's so important. It shows us the actual money coming in and going out, like a financial x-ray. This tells us if they can actually operate, invest, and, pay their bills. A company can look profitable on paper, but still be in trouble if their cash flow isn't healthy.
It's like having a big salary, but your bank account's empty. Looks good on paper, but you can't actually spend anything.
Exactly. That's why we need to look at this statement. It tells us if HDFC is managing their money well enough to not just survive, but really thrive. We need to look at all three parts: operating activities, investing activities, and financing activities.
Okay, let's start with operating activities. What does this tell us?
This is the cash they get from their main business, their banking operations, interest income, fees, the day-to-day stuff. You want to see positive cash flow here. It means their core business is healthy and profitable.
So is HDFC's core business healthy? Are they making money?
Well, it's a mixed bag. Sometimes it's good, strong, positive cash flow, but then there are times when it goes negative. This inconsistency makes you wonder if they can consistently generate cash from their main business.
Kind of like their engine's not always running smoothly. What's causing those ups and downs? Is that a big problem?
We need to figure that out. Are these dips just because of the time of year? Or are they one-off events, maybe a big loan repayment? Or is it something more serious, a problem with how they manage their cash? The latest numbers are good, but they need consistent positive cash flow for real stability.
All right, on to the next section, investing activities. What's this about?
This shows us how much cash HDFC is spending on investments, things like buying assets, expanding their business, or investing in other companies. It also shows what they get from selling assets. This section tells us about their growth strategy.
So it's like seeing where they're placing their bets for the future, right? Are they making good investments?
It looks like they're spending a lot more on investments lately, especially by March 2024. This suggests they're going after growth opportunities, which is good if those investments pay off. It's like a gardener planting seeds. Got to put in the work now to get results later.
But like a gardener, they have to pick the right seeds and take care of them. Are there any red flags, anything that worries you about their investments?
Hard to say without knowing exactly what they're investing in. We need to know the details, the risks, and the potential rewards. It's like looking at a menu. You need more than just the description to know if the dish is worth ordering.
Okay, last section, financing activities. What's this one all about?
This is about raising and repaying money, issuing debt, selling shares, paying dividends, buying back their own stock. This tells us how they're financing their growth and managing their debt.
So it's like their financial toolbox. What are they using to fuel their business?
It seems they're relying a lot on borrowing, issuing debt to finance their operations and those investments we talked about. This fits with the big increase in borrowing we saw before. Using debt can be smart, but too much can be dangerous, especially if the economy takes a hit.
Makes sense. Too much debt is like building a house on a weak foundation. One strong wind and the whole thing comes crashing down.
Exactly. So they're walking a fine line here, using debt to grow, but also trying to manage it responsibly. What's your overall impression of their cash flow? Are you worried about their financial health?
Well, the ups and downs in their operating cash flow and all that borrowing do make me a little nervous.
Yeah.
They're definitely focused on growth, but can they generate enough cash from their main business and manage their debt in the long run? That's the big question.
I think that's a great point. As you continue your research, really dig into the why. Why is their profit margin shrinking? What are they investing in? Compare their performance to their competitors, look at their overall strategy.
This has been incredibly helpful. I feel like I have a much better understanding of HDFC Bank's financials now. Thanks for walking me through it.
You're welcome. Remember, the more you know, the better decisions you can make. Good luck with your research.